All right, let's bring on Mahmoud Noorani, CEO of Quant Insight. It's good to have you on today. Thank you for joining us.
Thank you for having me.
Definitely, it's great to have you on, and let's start talking about what's going on in the markets. But before we get into 23, let's start off with your perspective on how 22 went for investors and how it could be different in 23.
Well, I was sitting here just waiting to come on, thinking about an interview I gave exactly a year ago, when basically the message was that it's going to be a tough year. Now, the reason it was a tough year was the Fed had to fight inflation, and they have moved rates from 0 to above 4%, and that has brought equities down. 2023 is going to be different, but in a way similar. And it's going to be different because the story isn't really about rates anymore. The story is going to be about the impact that that rate move from 0 to 4 and whatever is going to have on the economy. And that, again, unfortunately, means it's going to be a tricky year, and you're probably well advised to stay nimble and not get married to anything.
Yeah, and it's difficult, especially when, of course, we are getting some kind of outlook from the Fed, but we don't really know where that terminal rate ends, right? So it's tough on models to try to model out the future when you don't exactly know what's coming, right?
Yeah, and look, when you look at all the data, I think the Fed is going to, by February, get a bit frustrated and think about moving rates even higher, because the facts are that we're ending the year with real growth, real economic growth around the 2% annualized level. We had the labor report that shows unemployment at 3.5%. I mean, that's very, very low. You have wage growth going at 5%, and the Fed wants that at 2%. You have corporate defaults hit the lowest in the last 10 years in 2022. And of course, you have inflation, headline inflation around 7%. Core is expected on Thursday at like 5.7%. Some of the big inflation analysts out there are pointing to some downside risks, so maybe you get 5.5 or 5.6. But given that we've gone from 0 to above 4 in terms of interest rates, that's an enormous increase in a short space of time. The economy is doing much better than anyone would have expected. So there's a lot of head scratching going on. Yeah. And the risk is that the Fed decides to sort of move it above 5 to try and get kind of wage growth down and inflation down to 2. That's the risk we're looking at.
Yeah, what do you expect on the outlook there? And do you think that they'll continue to play that extreme game and potentially just drive us into the recession?
I think, unfortunately, they probably are going to do that. And, there are a lot of factors at play. I mean, all central banks globally, whether it's the European Central Bank or the Fed, I mean, the core theory here is that the best thing long term for the economy is a stable and low inflation rate. People can plan, companies know where to put contracts. It's an environment of kind of low and stable inflation. And they put a huge level of importance on getting to that. And so their thinking is, yeah, there may be short-term pain, but this is long-term gain. The other elephant in the room, of course, is with the amount of debt out there, government debt, for example, long-dated debt. If the Fed starts to waver on kind of getting inflation down, it loses its credibility, and you could see long-end government yields go to wherever, 6%, 7%, 8%, who knows? And then we're in a whole world of problems of a different sort. So I think the Fed is pretty determined. And we're going to see around February or March whether the labor market starts to soften and wages start to go down. We have a little bit of a window in January. We had this ISM services number, and it's this Institute of Supply Management. They do a survey of businesses, and it was a very, very weak number. Now, services are the biggest part of the US economy. I think manufacturing is 25%, services 75%. So that has given the market a bit of a sense that, hey, things are slowing. And what you're seeing now is a bit of a debate around the soft landing. Hey, maybe the Fed will be able to engineer this kind of nice soft landing where inflation continues to go down smoothly. GDP, I mean, Goldman Sachs chief economist last week predicted positive 1% real GDP growth for 2023. Not bad. I would take that.
Yeah.
That would be, if they get inflation down and we end up with 1% real GDP growth, that's a phenomenal result. That is your upside, really. You get that sort of outcome. The downside is that they need to hit the brakes harder to get inflation down. And we're going to kind of get a much better sense for that around February, March.
Of course, that energy sector has been so strong, right? It's been the leading sector now for 2 years. Do you expect to continue seeing it the leading sector?
So energy is really interesting. We've done a bit of fundamental research. I mean, we're more quantitative and machine learning and data analysis, but we have done some work on oil. And given the China reopening, we see a bit of a shortage in the crude oil market. And so that is constructive for crude oil. And so we quite like the XOP energy and natural gas producers ETF. We think that the materials complex is interesting. And the other area that's sticking out is China. And China has really been the sort of forgotten, avoided market for the last few years. There have been political issues. People have been worried about Taiwan. CEOs have sort of been disappearing of big tech companies, and it's sort of been avoid. But now with the reopening, there's some really interesting data out there on the amount of savings that have built up. And there's this growing expectation that you're going to get this very strong economic rebound in China this year. And a really interesting fund manager survey by Bank of America Merrill Lynch pointed out that in the last month or so, the big institutions have, for the first time in a while, really started to increase their exposure to China. And so we think that's another one, given how poorly China has performed and how avoided it's been for a while. You add this reopening news, I think China's an interesting story as well.
Of course. Now, one of the biggest tips that I got when I was in school is we're focusing on two things, right? Focusing on what the fiscal policy was doing and what the monetary policy was doing, right? How can Quant Insight help distinguish here through the macro noise so that we, retail, can somewhat understand what's going on?
Yeah, so what we do is we bring together all sorts of high frequency economic indicators. So for example, we have a measure of daily real GDP growth for 22 countries. It's taking all the data, retail sales and all this sort of stuff, giving you kind of the best guess, what does the current quarter look like? We take data, daily data on global markets for inflation expectations, data on expected probability of default by corporates in the US, in Europe, in Japan, and all sorts of data that correlates to fiscal policy, the shape of the yield curve and other indicators. And we feed that all into a big machine, and this machine basically starts untangling it all and starts to tell us which of those economic indicators are explaining price movements of all sorts of things over quite a long period of time. So you get quite a lot of confidence that this is real, it's not coincidental. And so the big message in 2022 was that real interest rates and Fed rates, those little daily movements in all those Fed and rate indicators, were really explaining a very big percentage of the little daily movements of, for example, the S&P 500. Tech stocks were being explained by rates. So it was very clear to us, February, March, that if the Fed really does start now to hike, tech is going to be really vulnerable. And what we're seeing now, we've seen a bit of a shift, is that what's explaining those little variations is really two things. It's the state of the economy, so these daily real GDP estimates. They're having a big impact on whether it's the broad indices, different sectors, and also another variable that unfortunately is hard to get hold of, but very well watched in the institutional world, and that's the cost that corporations pay, particularly the lower rated, so-called triple B, lower rated corporations, the cost they pay to borrow money for 5 years. And that cost reflects the market's expectation of the default rate. Now, the default rate for low-rated corporates in 2022 was kind of around 2.5%. In the great financial crisis, we got to 8. In 2020, COVID crisis, we got to around 6.5. So if that indicator starts to show that there's corporate distress around the corner, and if real GDP growth starts to head south, then you're going to see markets weaken. That's what they're trading off. So those are kinds of the things we do and how we do them.
Definitely. I'm going to go ahead and throw up the link here if you guys want to check out Quant Insight and learn a little bit more about this. And I think it's always important. I ask myself this question often: what current environment are we in? It looks like, of course, Quant Insight can help solve that for you.
Hopefully, yes. And we have a new retail platform, all free, on the Discord platform for retailing. Although there are a lot of hedge fund managers and institutions, big conversation going on about all these topics. And the more the merrier.
Hey, I love it, Mahmoud. I'm definitely have to tune in there myself, put that Discord to work. Appreciate you coming on, and we'll definitely have you back on. Have a good one.
Take care. All the best. Thank you.